Enron was a former energy, commodities and services company based in Houston, Texas, before bankruptcy in 2001. Enron was one of the world's most innovative and successful companies, employing 21,000 people in more than 40 countries.
By shuffling debt obligations into offshore partners and reporting inaccurate trading revenues, our firm became the seventh largest corporation in America, trading shares at high as $85 before fraud was discovered. All of our success came crashing down as the firm shocked investors in October 2011, when although our auditors from Arthur Andersen reviewed and approved all of our transactions. Along with Arthur Andersen, we were forced to acknowledge that there was improper accounting treatment and revised our financial statements for the previous 5 years, acknowledging that instead of taking profits, we had actually postponed $586 million in losses and had to take $1.2 billion reduction in shareholder equity owing to partnerships created by the company. Our stock value became to crater, falling below $1 per share, and in December 2011, we declared bankruptcy and 20,000 people were made redundant, and thousands of investors, including a large number of employees, whose stock plans had become almost worthless as they lost billions of dollars as our share prices decreased dramatically.
In early January of 2002, Enron was listed, and as we started investigations into Enron's financial dealings, many revelations came about which outlined stories of Enron's top executives willingly ignoring internal financial warnings and acquired millions of dollars on the stock market before it became clear to the public that Enron was going to collapse.
Further disclosures highlighted the accountant's central role in the scandals surrounding Enron. The audit company, Arthur Andersen, neglected to recognize the company's problems, and investigators say they were complicit in perpetrating one of the biggest frauds in corporate history.
We found the accountancy firm Arthur Andersen guilty of obstructing justice by shredding documents relating to the failed energy giant Enron. We stated the firm sought to undermine our justice systems by destroying evidence, knowing that such documents we could use in the investigation.
As it has been highlighted so far, the situation at hand was faced with greed, collusion, and an obvious disregard of any notion of ethics amongst company executives, the external auditors, Arthur Andersen, the outside legal counsellors, the bankers, and the investment firms. It is unlikely that any form of regulation would have been able to prevent the financial losses to employees, shareholders, and the creditors of Enron.
Our team at Arthur Andersen, along with Enron, violated many generally accepted accounting principles, and apart from misaccounting issues, a number of auditing issues came about in the scandal, such as our independence. Our firm was consulting as well as auditing at Enron, which raised questions as to how we could have acted in an independent manner when auditing Enron's work as consultants. It appeared our audit team chose to ignore accounting issues when faced with them. Internal control weaknesses. Not only was it clear that Enron had too many internal control weaknesses, which were not noted by our firm, it was also found to be that we also had serious internal control weakness. As auditor, we are to focus on material misrepresentation. Therefore, we should have acknowledged the errors, although they were dismissed by us as immaterial. Related party transaction which Enron's CFO was undertaking, acting as a buyer and seller in the same transaction, should have created alert to the audit committee to go externally to find evidence on the irregular transactions.
As a result, Andersen lost its credibility and lost clients. A criminal conviction and unprofessional misconduct would mean they also lost their license to practice accounting in the state of Texas. Although this only applied to Texas, it destroyed the firm's integrity, and Andersen announced its intent to cease operations.
Arthur Andersen received the ultimate punishment, being forced into bankruptcy by the marketplace as reputation of honesty was destroyed. America's oldest accounting firm fell along with Enron, while many other American companies scrambled to re-examine or explain their own accounting practices. Enron was the first big company to be an accounting scandal, and the fall of Enron will be known for decades to come as one of America's greatest business debacle.
Our team and the State Board of Public Accountancy, as well as the US Congress, acted quickly and began reforms that may minimise similar losses in the future.